market, as you point out, initial reaction is dollar up, other assets down. And then as we kind of move through the day, people kind of realize, well, this is kind of just noise in the grand scheme of things. It's 1 month. I think it shows that we still have sticky inflation. My view for a while has been inflation pressures are pretty significant. And this is showing that it's still an issue. Some of this is still left over from prior money printing. So it takes time for increase in money supply to work its way through all sorts of prices. If cars go up in price quickly, which is what happened, then things like car insurance and stuff like that can go up with a lag. So that's still working its way through the system. And then two, we're still running like 7% of GDP fiscal deficits. That's all else being equal, at least, an inflationary force. So even with energy prices fairly range bound and a lot of things more controlled than they were a few years ago, this just shows kind of the nature of the problem. The fact that we're still in 2025 talking about above target inflation, I think is telling. All else being equal, Powell's recent comments were on the hawkish side, which is to say there's no rush to cut rates, there's no rush to go back to balance sheet increases or to cease balance sheet reduction anytime soon. So this gives the Fed a little bit more hawkishness in their narrative, at least until we get maybe a couple soft prints. Fiscal dominance is a really important thing. So the size of the fiscal deficits, as well as any other actions by the executive branch, such as tariffs, those are, in my view, the bigger headlines to be focusing on. Whereas 25 or 50 basis points is less relevant for most investors than I think the consensus would say. In a period of structural monetary dominance, the Fed and the overall banking system plays a really big role. But in the current period, they mainly help with liquidity, put out fires. We're seeing a lot of the money creation happen around the banking system. So instead of rapid bank lending causing this inflation, it's generally large fiscal deficits. And so while things like balance sheet size matter, other policies matter, things that they could do around, say, SLR exemptions, basically changing the nature, the regulations around how easy it is for banks to hold treasuries. It's not that they're irrelevant. They do affect liquidity and therefore they can affect asset prices. They can affect the structure of the banking system. I just think the far bigger things that outweigh those, especially 50 basis point rates in either direction, is greatly outweighed by, do the deficits stay as big as they are, or do they get meaningfully lower? And what does tariff policy look like 3 months, 6 months, 12 months, 18 months from now? Well, so it's interesting. Most countries with large sovereign wealth funds relative to their GDP have current account surpluses. That's basically where they accumulate all this excess value that they want to stick somewhere. It's pretty interesting to do it from the perspective of a twin deficit nation. Even some fairly large numbers, like a couple $100 billion, would be small as a percentage of GDP. So I think there's a lot of narrative around it, but that potential effects are relatively muted. Obviously, for relatively small assets like Bitcoin, a $2 trillion asset, more or less, any action to acquire a meaningful amount of Bitcoin would be relevant for the market. They've also talked about, putting strategic interest in there, which I don't think that's great. And we'll see to what extent is just done through executive action or that is done more kind of thoroughly through legislative action that is then signed into law by the president. On average, I take the under on what these things will look like, meaning that I wouldn't be shocked if we have in the years ahead a fairly large sovereign wealth fund. But my base case is that probably the actions there will be smaller than maybe many participants expect. But we have to kind of monitor that how we go. I think so far what's different this time is that they're coming in harder. This time, they're coming in with a much more collectively anti-establishment set of views that are generally more in alignment and really hitting the ground harder and faster than last time and seemingly willing to take bigger actions. So obviously the Doge thing has been pretty impactful, as well as the tariff policy. The initial shock and all of 25% tariffs on some of the US's closest allies was interesting, but then were quickly walked back with some kind of optical concessions and things like that. That's kind of one of the biggest variables to watch, because one of the most challenging things that I think the Trump administration is going to go through is the fundamental nature of the trade deficits. So they made that a priority in the first term. They didn't really make a dent in them. And it's partially because it's actually a really, really hard problem. The US as the global reserve currency is something they explicitly want to maintain and even take steps to increase the dominance of. But the fact that the dollar is the world reserve currency plays a big role in creating those trade deficits, because what it does is there's all this extra demand for dollars and dollar-denominated assets, so it boosts Americans' import power, and then it makes our export competitiveness for low-margin things less competitive. And so it kind of forces open this trade deficit, which is how the world gets supplied with dollars in order to keep using the dollar as the global reserve currency. If they had a dollar shortage, they'd have to start generally selling dollar-denominated assets and unwinding a lot of that position. So the fact that the Trump administration wants to reduce the trade deficit, which is a noble goal. I mean, the deindustrialization has been an issue. It's caused all sorts of political issues, economic issues, structural imbalances. But when they want to approach that while fully preserving the current status quo of the dollar, it's just a really hard combination to do. So I think that we're going to go through a period of turbulence. And I would question at the end of the 4 years how meaningfully reduces the trade deficit. I would generally, on average, take the under, meaning that I think that we won't have as big of a change in the trade deficit as maybe some of the bulls think. But depending on certain policies, I could change my view on that. If you implement large tariffs, especially if you get in counter tariffs, that's basically a big global tax increase. If you don't meaningfully get through major tax reductions. So the Trump administration has talked about reducing income taxes, corporate taxes, locking in some of the prior taxes, that kind of thing. But risk is if you jack up tariffs and then other countries jack up tariffs and then there's not huge tax reduction elsewhere, then it's a really big tax increase. And that can increase the odds of recession or makes business planning a lot harder. If you're someone handling all these international contracts and you don't know if your specific industry or your specific country is going to be affected, everything's kind of in limbo for the next couple months in any given area, it just increases frictions and planning complexity. Kind of like how they want to decrease regulations to make things more efficient. Well, on the other side of the coin, a period of uncertainty is a period of inefficiency in a way. So that's just like an ongoing risk in the space. The biggest question is how hard they're going to push on it, because I think they absolutely could impact the economy. Let's say, hypothetically, you just put 20% or more tariffs on like everything. That's a pretty meaningful tax increase. And most, like any one thing could be changed pretty easily, domestic versus international. But when you're moving entire supply chains, so all the electronics that are made in China and all these other things made in other countries, a lot of them are energy intensive things to be doing. A lot of them are toxic, the rare earth metals and things like that. A lot of these are slow moving things that have various complexities and time to reshore. And then they come with a cost because they're not here for a reason. It's generally because they're more expensive to make them here. And so by moving them here, either because of tariffs or otherwise, you're generally bringing them into a higher cost jurisdiction, which then competes with the administration's goal of reducing inflation. Now, there's still other levers they can pull for reducing inflation, like decreasing the regulatory burden, making sure energy is flowing well, but they are somewhat in conflict. You know, we have the highest healthcare costs in the world. So any sort of manufacturing worker, as an employer, you're paying some of the highest healthcare costs in the world for them and various other frictions and costs. So there is not really a free lunch with some of this, even though I think some of the priorities make sense. This whole kind of modern period, like they call it the past 30 years, we've had a bigger than average gap between money supply growth and price inflation of consumer goods. And part of that is because we've had globalization. So after the NAFTA opened a lot of things, as well as the whole fall of the Soviet Union, the opening of China, basically we took all these kind of pools of labor, resources, connected them with Western capital, and kind of spread supply chains to the cheapest cost production. And there were losers to that. Like if you were industrially focused in the US, you were generally a loser of that whole trade. Consumers on average were winners. Wall Street was a big winner, government's a big winner. But basically this was a structural disinflationary force that we're now, for pretty good reasons, talking about unwinding. But it's always important to then be aware of the other side of that, which is say, if we are purposely trying to get companies to make things in higher cost jurisdictions, that generally comes with frictions. Now, there's different types of inflation. I mean, one is, in order to have like a sustained increase in prices across the board, you generally need money supply growth. That's kind of the core of what inflation is. Other things come down to where is like the share of margins and capital coming from. So in recent decades, really, in the United States, there's been more share of the economy going toward corporations and corporate margins and less toward labor wages, because now labor has to compete globally when before they didn't really have to as much. And so that's been generally negative for wages, really good for corporate profit margins. And so as you try to pull some of that back, it could be good for wages, but generally speaking, someone's paying that cost. Consumers are paying that cost. Company profit margins are potentially paying that cost. It depends on the specific tariff, the specific size, substitution options. But generally speaking, you're either taxing stuff that stays foreign, which is higher prices, or you relocate to a higher cost area, which has benefits, but then generally comes with higher prices. So there is potentially inflationary effects, but only if this is done at scale. Not in like specific industries or little like small tariff wars are generally not that inflationary. They don't need lower rates. It depends what else is happening. The cost of capital is a major input for valuation. But right now, for example, Costco is trading at like 60 times earnings, despite, rates being historically high still for the modern investor time frame. So clearly, it's not like a one-to-one correlation where higher rates means lower asset valuations. There's even certain environments, and this you normally see in emerging markets, which is that higher rates can actually fuel higher asset prices because you blow out the deficit even more. So I would actually relate things like money supply growth to asset prices more than rates per se. I think the current environment is kind of a mix for asset prices. On one hand, the high rate are increasing the deficit because all that interest expense is flowing out to a lot of private entities and foreign entities that own that debt and able to spend that interest, either accumulating more assets or going out and accumulating goods and services. So that's generally inflationary for asset prices. But the higher rates do put headwinds against how much you can reasonably pay for equities because, when you start to pay really super high, silly valuations, and you actually do have a pretty significant hurdle rate to clear in terms of the cost of capital, it keeps somewhat of a lid on that. And I think some of those really high valuation equities are at risk if we stay higher for longer. Probably Bitcoin if we're talking like sheer return potential, but I think there are a lot of really cheap equities, both in the US and internationally. And some of these policies could be better for them than we think. If you generally have, on average, sticky high inflation, some degree of deregulation, Trump putting pressure that he wants lower interest rates, and just in general, this ongoing fiscal environment, I think probably US banks are going to do better than expected. It's not a very liked asset class. Emerging markets are interesting right now. Basically, very underallocated. Nobody really wants them. The last thing people want to buy in a trade war is international stuff, but some of those are actually not that affected, in my view. I still think amid equities, there's actually still a lot of opportunity out there. When people see the expensive US market, they'll look at like market cap to GDP or the CAPE ratio. That's a collection of thousands of stocks. And there's actually plenty of areas that are trading at very normal valuations and that, in my view, still offer better return potential than bonds.